Hi, my name is Dana Sofia, and today I'm going to introduce what is accounting. So, accounting is a process of recording, summarizing, analyzing, and reporting financial transactions of a business or organization. It provides a clear picture of a company, financial, and help in decision making, budgeting, and compliance with legal requirements. So, next, I'm going to explain the concept. So for the first concept is actual. So actual is concerned with expected future cash receipt and payment. So record of all the expenses and income relating to the accounting period, whether actual cash have been or not. So the actual purchases or sales, wages outstanding, interest earned but not received. And for the example is, if company provide consulting service worth 5,000 in March, but the client will pay in April. So under the accrual basis, the company will record 5,000 as revenue in March because that is provided. So next, I'm going to explain going concern. So what is going concern is an accounting term for a company that has been resources needed to continue operating infinitely until it provides evidence to the contrary. So for example, if the company purchased a building for 500,000 and plan to use it over 25 years, so that is under the going concern assumption. So the building cost will be depreciated until its useful lifetime. So that's all for me. Thank you.
Okay, my name is Hafikin Amiwa Natasha binti Wasmin, and I'm going to explain two principles, which is consistency and matching principle. The first one is consistency principle. The explain behind it was the consistency principle is referred to accounting, means that a company should use the same accounting method and procedures from period to period to help ensure comparability of financial statement over time. So the example I would be given a straight line method to depreciate its equipment in 1 year. So if the business uses that straight line method, it should continue using it over time and following years. Changing the method without a valid reason will mislead users of financial statement. Okay, I will explain about the matching principle. The matching principle refers to expenses that should be recorded in the same accounting period as the revenue to help generate the revenue. This provides a more accurate picture of profitability. Example is, if a company pays commission to the sales staff, if a sale occurs in December and the commission is paid in January, the commission expense should still be recorded in December. So it's matching the revenue on December and not January because it related to December revenue.
Okay, right now we move to number 5, separate entity. The principle established that a business must be regarded as a distinct legal and accounting entity, separate from its owner or any other personal interest. In practice, this means that all business financial activities must be recorded independently from the personal transaction from its stakeholders. Even if the business is a sole proprietorship, where the owner and business are legally considered one, the accounting system must still treat them as two distinct entities. For example, imagine a small business owner who purchased a laptop for personal use and separately a laptop for the business. According to the separate entity principle, only the business-related purchase is recorded in the company's books. The personal purchase must not appear in the business financial statement, ensuring the report truly reflects the company's operation without the influence of personal transaction. This principle is critical for several reasons. First, it enables accurate measurement of a business's financial performance and position. Investor, creditor, and regulatory authorities rely on financial statements to assess the health of a business. And mixing personal and business transactions should distort this information. Second, the separation protects personal assets in certain legal structures like a corporate or limited liability companies, where the owner liability is limited to their investment in the business. Furthermore, when business grow and attract external investor or apply for loans, clearly separated records become essential. It provides assurance to external parties that the business is professionally managed and financially responsible. Without this principle, trust and credibility in the business reporting will be severely compromised. Next is number 6, monetary unit. The monetary unit principle dictates that only transactions that can be measured and expressed in the stable currency are recorded in the accounting system. Non-accountable elements, such as employee skills, brand reputation, or customer satisfaction, although extremely valuable, are not reflected in the financial records because they cannot be objectively measured in the monetary terms. For instance, in the United States, all business transactions are recorded using US dollars, while in Malaysia, transactions are recorded using the Malaysian ringgit. By doing so, businesses ensure that the financial reports are consistent, comparable, and understandable to all users. This principle also assumes that the value of the currency remains relatively stable over time, disregarding of the effects of inflation unless otherwise noted. Although this is a simplification, it is necessary for practically. Without a common monetary measure, it will be impossible to combine, compare, or aggregate financial information meaningfully. Consider an international company that operates in several countries. Its brand records transactions in a local currency first, then convert into a single reporting currency, such as the US dollar. For consolidated financial statement, thanks to the monetary unit principle, stakeholders can make informed decisions based on consistent and comparable financial data, regardless of where the transaction occurred. Moreover, this principle highlights the limitation of accounting. Not everything important can be captured in numbers. However, by focusing only on measurable financial information, accounting remains objective and avoids subjective estimation that could vary widely between businesses. We'll move to number 7, historical cost. The historical cost principle requires that all assets and liabilities be recorded at their original acquisition cost rather than their current market value. This means that the amount paid at the time of purchases being picked by variable documentation such as invoice or contract is the value recorded in the financial statement. For example, if a company purchased a machine for $100, that amount is recorded as the asset value. Even if the market price of the machine rises $120 or falls to $90, the machine remains recorded at its original historical cost until it's sold to otherwise disposed of. The importance of this principle lies in objectivity and reliability. Historical cost provides a clear factual basis for recording transactions, avoiding the uncertainties and fluctuation of market value estimates. Financial statements based on historical costs are easier to audit and verify because they are supported by concrete evidence. However, it is important to note that while historical cost promotes consistency and variability, it may not always reflect the true current value of an asset. As a result, for certain types of assets, such as marketable securities or investment properties, fair value accounting may be used alongside or instead of historical costs to provide more relevant information to users. Nevertheless, for the vast majority of fixed asset and long-term investments, the historical cost principle remains the foundation of accounting practices. It ensures that the financial records are grounded in actual, variable transaction rather than subjective market speculation, contributing to the credibility and reliability of the company's financial reports.
Assalamualaikum, my name is Sofianara. So now I'm gonna explain about basic accounting principle. The first one is materiality, second periodicity, and the last one is comparability. So for the first one is materiality. So materiality in basic accounting principle is that can influence user decision should be record or report properly. And also materiality is one of the essential accounting concept that designed to ensure all of the information related to the business and are present in the financial statement, and also ensure that the financial statement user is provide with financial information and does not have any significant misstatement. So how this factor apply in our life, especially for business. So for example, I take a Toshiba Malaysia. Okay, so Toshiba Malaysia, imagine Toshiba Malaysia prepare a financial report, and one of their sale is 500 million, and during the year, one of their employee forgot to record the loss of a microwave oven from the warehouse. It's worth 200. So should Toshiba worry a lot about that 200? The question is, so 200 compared to 500 million is very very small. So it won't affect how investor, bank or manager judge Toshiba financial health. So the conclusion is 200 is immaterial, and they might just mention it briefly or even ignore it in the full financial report. Next factor is a periodicity. Periodicity in accounting we can divide to a regular period like month, quarters and year to measure a business performance. Even though a business is continuous, accountant must stop at a regular time to prepare report like a monthly report, quarterly report, and also yearly financial statement. So how this factor apply in our life, especially for business, is, for example, I take a Toshiba. Toshiba doesn't just wait forever to report their profit. So every 12 months, one accounting year, they will prepare a financial report such as income statement and also balance sheet. Sometimes they also prepare a quarterly report every 3 months, and also even though Toshiba will continue operating next year, it must close the book each year to show a result. So the last factor is comparability. Comparability is accounting information must be prepared in a way that it can be compared easily over different periods and between different companies. So how this factor apply in daily life, especially for business, is, for example, I take a Toshiba. If Toshiba use one accounting method this year, for example like a straight line depreciation, they should use the same method for the next year, because this is the way investor can compare this year profit with last year profit fairly.
So, in conclusion of all of our context, I would say that serve as the foundational framework for accurate and reliable financial reporting. This principle ensures that financial statements are prepared consistently and transparently. Enables stakeholders to make informed decisions adherent to this concept. It's essential for maintaining the integrity and comparability of financial information across different periods and entities. Thank you.